I have been through 3 financial collapses, and the part most people miss is that the crisis itself is usually not the real story. The real story is the mechanism underneath it. Markets rarely break because of headlines. They break because of pressure building quietly inside the financial plumbing. In our strategy, we focus less on predictions and more on understanding the sequence of events that tends to show up before major disruptions. Once you understand the sequence, you begin to see that different crises may look different on the surface, but underneath, they often follow familiar structural patterns. The first pattern tends to begin with inflation pressure and rising interest rates. When inflation rises, central banks tighten policy, rates move higher, and suddenly the entire system begins to feel stress. Borrowers who previously refinanced easily now face higher costs. Banks that hold long-term loans must pay higher rates to depositors. The gap between assets and liabilities starts to compress. That is when refinancing begins to fail, and defaults begin to appear. This is not usually dramatic at first. It unfolds slowly. Loans reset. Credit becomes harder to obtain. Projects that worked financially a few years earlier no longer work at higher borrowing costs. Over time, that pressure begins to spread through housing, commercial lending, and eventually the broader economy. A second pattern shows up in speculative markets. This tends to happen when excitement about a new technology or a new opportunity pulls capital toward assets that have strong narratives but weak earnings. During these periods, prices rise rapidly because investors expect future growth. But when profits fail to match expectations, the marginal buyer disappears and prices begin to correct. What matters here is not the story itself. It is the shift in psychology. Once confidence fades, valuation multiples compress quickly. Markets that rose on enthusiasm begin to fall on skepticism. The third pattern tends to appear in housing and credit markets. Low interest rates encourage borrowing. Policy often encourages home ownership or credit expansion. Lending standards gradually loosen. Prices rise, which encourages even more borrowing. Rising collateral values make the system appear stable, but the stability depends entirely on prices continuing to rise. When affordability breaks or refinancing becomes difficult, the system reverses. Defaults rise. Inventory rises. Prices adjust downward. Because housing connects consumers, banks, and collateral values, the feedback loop can become powerful. If you find this kind of structural analysis useful, consider subscribing. The goal of this channel is to break down the mechanisms that drive markets so you can better recognize patterns that often develop months or even years before major financial shifts appear in the headlines. When we translate these patterns into our framework, we look at market cycles as a sequence of phases. The current environment still shows characteristics of late cycle expansion, where asset prices remain elevated, but underlying financial conditions are gradually tightening. In this type of phase, the market can continue to move higher even while fragility builds beneath the surface. That is why confirmation signals matter more than narratives. A brief note before continuing. Everything discussed here is educational and informational. It is not investment advice and should not be interpreted as a recommendation to buy or sell any asset. What we watch most closely are the indicators that tend to confirm when pressure is building in the system. Credit spreads widening, lending standards tightening, treasury auctions showing weaker demand, labor data softening beneath the headline numbers, housing activity moving from frozen transactions toward measurable financial stress. If those signals begin to align, the system can move from a late expansion phase toward a more unstable period where forced selling becomes possible. If those signals do not appear, the cycle can continue longer than many people expect. Markets often stay resilient while liquidity remains available. The discipline is not about predicting the exact moment something breaks. The discipline is about recognizing the mechanisms that tend to create opportunity windows once the cycle turns. History shows that the periods when fear is highest are often the same periods when forced selling creates the most attractive long-term entry points. But those windows usually appear only after liquidity stress forces prices to adjust. The key is patience, awareness, and understanding the sequence rather than reacting to headlines.